Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 25 minutes or so. So this week is starting out a little bumpy, but then again, everything in the world seems to be a little bumpy at this point in time. So right now we have the S&P 500 index. It was trading down. Now it's kind of worked its way back to flat. But we do have the VIX index up around the 21% level. So I would consider that high implied volatility. The Russell 2000 index actually hit a 52-week low today. So kind of showing the dichotomy between the mega cap tech stocks, which quite a few of them are going to be announcing earnings this week, and what's going on with the mid caps and the small caps. So right now, we see the S&P 500 index, all of the mega tech stocks, I should say, ones that most of them are involved, that are considered to be involved with AI, have really been holding the market up. The general PE ratios on those stocks have been, okay. They've been a little bit inflated. A lot of people would say overbought. Whereas a lot of the other stocks that make up the index are trading at lower than normal PEs. So the Magnificent Seven have definitely been magnificent, and they've been holding up the marketplace. So this week we're going to focus on earnings. We do have first to kick. Well, we had Netflix kick off earnings of the big mega cap tech stocks last week, and they did very well with their earnings report, and the stock made a nice move upward. But this week we have Microsoft and we have Alphabet that are going to be announcing Tuesday after the close. Then on Wednesday we have Meta, and then on Thursday we'll have Amazon. And I always like to look at the Amazon trade because it's a great learning experience for option traders in general to have a big mega cap tech stock announcing on a Thursday after the close, when you have a Friday expiration and only one day for those option contracts to live. So you get all the pumped up implied volatility that comes with an earnings report and a high price stock. The more expensive the underlying stock, the more expensive the options are going to be. And then that after that close on Friday, after that earnings announcement, that all of that juice has to go away. The implied vol premium has to go away. The time value of those option contracts have to go away. And so it's the one time it's one of the only times that you can really know what's going to happen with implied volatility and time value. That's straightforward. You have one day, it has to go away. So I'm going to start by doing a couple of butterflies this week. The first one in our long portfolio, if you will, over on the paper trading side of things. The one beautiful thing about the TradeHawk software is we do also have a live trading situation and a paper trading situation. So we've started to build a portfolio with a couple of stocks by buying deep into money options and selling shorter term calls against it. We did that in Google, so I'll talk a little bit about that because they're going to be going into earnings. And then today we're going to do just speculation. We're going to look at a standard butterfly in Microsoft, and we're going to look at a couple of them. So this is going to be a fairly advanced week as far as Options Guy TV is concerned. And it's just because it is interesting to look at strategies around these big stocks that get a lot of attention. Most brokerage firms, if you have a portfolio in it, you have at least one of the Magnificent Seven stocks in that portfolio of stocks, at least one. And a lot of people have two or three of them. They are really the driver of the marketplace, and part of the reason why the markets have performed fairly well this year in general. And it has a lot of people are giving the credit to AI and the new technology and that type of thing. So let's look at Microsoft. And I'm going to be bullish on Microsoft, not necessarily because I think that I should be bullish on Microsoft. We are a little bit inflated on the price. Alphabet and Microsoft Well, Alphabet is actually out of the Magnificent Seven, trading probably at the better PE than any of the other stocks that are in that index, Microsoft included. It's a little bit inflated, but we're gonna do a long call butterfly in Microsoft. Now, it's meant to be a paper trade, especially a speculation trade like this. It's not meant to be a recommendation. And you can take the same concepts that we talked about and try to apply it to the opposite side of this trade. In other words, you could do a put butterfly and be bearish on the marketplace. We're going to use calls because we're going to assume that we could get a gap up in the underlying stock after their earnings report. No guarantee of that, but that's the way that we're going to approach this. So let's run to the option chains on the TradeHawk software. And we see Microsoft right now is trading at 328.41. It's up about 54 cents on the day. And these are the markets in general. We're seeing the financial stocks have already kicked off earnings. Sad to see Charles Schwab, one of the stalwarts in the financial industry and the brokerage industry in general and banking, has been beaten up lately. It's down around that 50% level. Gold is trading flat. We see the big news today is what's happening in the 10-year and the yields, and that probably has something to do with Charles Schwab. It's implied that this is the TNX, which it tracks the yield in the 10-year bond, and that actually touched 5 today. So 5 seems to be the 5% level. It seems to be the line in the sand. If we broke above that level, I think the markets would really get spooked. At this point in time, we keep going up to it and bumping up against it. But every time you bump up against it, the odds of breaking out go higher and higher. At least that's what a lot of chartists like to think. So all you do is just move the decimal point over one spot, and we see that the yield right now is at 4.89%. So that's probably one of the biggest things that's dragging on the marketplace is where the 10-year is at. In November, they're no longer pricing in any probability on the futures marketplace that there will be a rate hike. It came down precipitously since the last time the Fed had a conversation. So we started at about a 40% probability based off of the futures, and it dropped down to 20%. Before you know it, last week it was at 6%. Now they don't have any probability of it pricing in, but they still are showing about a 0.25% point rate hike in December. So there is a chance that they're on the next Fed funds meeting that they still raise it, and I'm kind of surprised by that. But oh well, the Fed will do what the Fed will do. But so let me see, that meeting is going to be this. Let me go and take a peek here. Yeah, December 13th, 2023. We're looking at a 75% chance that they stay the same and a 25% chance that they raise rates 0.25% on the Fed funds rate. Okay, so let's look at Microsoft. Let's look at the one thing that's kind of fun about this trade is that they are announcing tomorrow after the close. So the caveat would be that I would probably set this up closer to the close tomorrow. We don't have Options Guy TV tomorrow, so we're going to set it up today based off of the market information. But the same concepts apply whenever we're looking at a long butterfly, especially a speculative one around earnings. And we'll look at the what-if strategies and take a peek at that. So market right now is at 328.29. We're trading at a 53% implied volatility. So you can see the skew. The market knows that there's something going on in the shorter term because we go from 53% down to 38. So we are in the right expiration date. I always like to double check that. And then we're going to take a peek. We'll start by, let me clear this out, and we'll start by just buying the long straddle. Okay, so we'll buy that one and we'll buy that one and let that kick in. 37.25. Oh, I sold it. That's why that's not working. Okay. Let's click buy. There we go. So we're right around, well, it's showing exactly 15 points on the midpoint. So you want to sound like an options analyst? You just look at the long straddle. And when a reporter calls up and says, what's the expected move in Microsoft? You take 15 divided by 328, and you're looking at about a 4.5% move. So the marketplace is pricing in a 4.5% move. That's about 15 points. Now, the best way that I can always think of this is like an over under, if you do any betting at all, on it's now football season on a football score. So a lot of times people will say, well, this football game, they're expected to score 40 points. Do you think that both teams combined will score more than 40 points or less than 40 points? And to me, that's the best way to think of the expected move. 15 points is what the marketplace is saying. Well, this is a potential move, a 4.5% move after the earnings. And that goes all the way to October 27th, though, because we're using those option contracts, right? So that's for 4 days. But a lot of people think of it just, that the earnings report is going to be the big day. So we're saying 4.5% is the expected move on Microsoft after this earnings report. And that's 15 points. So one thing that I want to do on my butterfly is I want to take what the marketplace is telling me, and I want to center my strikes and my options around that expected move. So we'll call it 329. So if I go in, the market's at 329 right now. We take 329, add 15, the middle strike 344. So I want to keep that in mind. So we're somewhere right around here where the expected move is at. Now, in the TradeHawk software, we have a very nice feature here at Tradier that highlights where a one standard deviation move is, which is always a little bit bigger than the expected move. And that one standard deviation move is trading here where we got the 16 delta. So it's right at 347.50. So you're still within a range that could possibly happen. And that's the way that I look at the one standard deviation move. The expected move is saying that the marketplace is thinking this could move 15 points in either direction. There's no regard to direction whenever you're looking at these mathematical numbers, probabilities. A lot of times it has no regard to direction. But if it does start moving, they're saying it could go 15 points in either direction. So we're going to center this. I'm going to skew it a little bit more to the upside than to the downside on this trade. And we're going to go 10 points wide. We can get a decent amount of, a decent price. And part of the reason why we can go wider and do this for a minimal dollar amount, which means minimal risk, is because we have pumped up implied volatility, because we have we have that pumped up juice from that implied volatility, and we have a fairly expensive underlying that's trading at $329. So these option contracts, as implied volatility increases, butterflies become cheaper. If you're correct on your forecast, you want implied volatilities to go down after the trade is put on. And I'm going to show you that in the options playbook here in just a second. But let's set up this trade, and then we'll go and take a peek at some profit and loss graphs and talk a little bit about, well, just why somebody would want to do a butterfly around a earnings report or a known news event. Okay, so I'm going to clear this out. Here we go. And so 345, I don't mind centering it there, but I'm going to go a little bit wider than that. Let's go 340 is the one that we're going to buy. That gives us that opportunity. We'd have to pay $3 for that option contract if we're buying it outright, 310 to be more exact. And then we're going to sell the 350 here, and we're going to sell 2 of those. So it's highlighting the spread legs of our butterfly. And then we're going to jump up to the 360, and this is going to be our protection. And we're going to buy one of those. So if we bought this option outright, which is feasible, but it also means that the market's got to at least move to that level, we're paying $3 in pumped up premium. Implied volatility is around 50% on that. It's within the expected move. I was just speculating on buying a long call option, I'd probably stick somewhere within that range. That would be 100% speculation. Let's just flip that coin and say we're going to blow this thing out of the water, so we're going to buy a long call. This is the one that I would focus on. It's within the expected move, but you're still paying a lot of juice. Don't really like that much because there's so much juice in it. So now we're going to buy that thing, but we're going to get it done for a lot. It's going to be beneficial to us if we get that move above 340 all the way up to 350. So we got a 10-point range that it can land in. And then in order to protect ourselves from 350 on up, well, we're still doing okay, almost up to the 360 price. But from 360 and beyond, we're going to lose our premium. So that gives us about a 20-point range, less what we paid for the butterfly, and we've greatly reduced our costs. We've gone from $3 down to $1.24. This means for every 1 by 2 by 1 butterfly, it trades as a unit. We're going to pay $124 plus commission to put that trade on. I always want to put in commissions whenever you're doing any of these trades, depending on your situation with your broker. Okay, so if we look at the profit and loss graph on optionsplaybook.com, so let's zoom out here just a second, and let me grab Options Playbook. All righty. And what we're going to look at here is what a long call butterfly looks like inside the Options Playbook. Come on. There we go. All right. So we're back. Long call butterfly spread. So one of the things that I highlighted inside the book, which all the text here is inside optionsplaybook.com, is if you put on this trade, we talk about the strategy. This is more of a neutral outlook on the market inside the playbook, but I really like to use butterflies and point them in a direction because they get much cheaper if you're going to be bullish to just go a little bit further out of the money and put the butterfly there and use calls. And if you're bearish, use puts and go a little bit further out of the money. But we talk about here what happens to implied volatility after the trade is put on. So after the strategy is established, implied volatility is where your stock is at. But if your forecast is correct, you want volatility to decrease in price. So if your forecast was correct, the stock price is at or beyond around strike B. That's the center strike of the strategy. You want implied volatility to come in. And that's one thing that we can control around an earnings report. Most of the time, I should say 99% of the time, implied volatility will be trading at a lower rate than it was prior to the announcement. And so if we are correct on our forecasts, we want that to come down. And we want those center strike, which in Options Playbook, I'll come up here, which is strike B. And in our instance, I think it was the 150 strike. You want those option contracts to decay, and you want to be able to buy them back for as little as possible because you are now trying to buy 2 at-the-money option contracts that you have sold. So we're selling those strikes at strike B. So this is why I find it interesting to do butterflies around earnings reports. And because it's one component of the butterfly that you can kind of control. Now, you still got to get the underlying stock to land within a certain range, which is hard around earnings. But once again, you can widen your butterfly because implied volatilities are higher and giving you a wider range for the underlying stock to land in. And in our case, that was right around 20 points. The width between the strike A that we're buying and strike C that we're selling. So I'm going to run back to the software here. Let's go full screen for a second. And let's look at the what if calculator inside the Options Playbook. And at this time, I think it is a great opportunity to say, if you have any questions, please feel free to put them in the chat box. If you are on the YouTube platform, you can put those in the chat box and I will be happy to address them. I really want Options Guy TV to be as interactive as possible. So if you do have any questions about Google, Microsoft, anything that has any of the stocks that we're going to be looking at earnings at for this week, the mega cap topics, feel free, put them in there. We'll try to address them. Okay. So here's our this is going to be our official paper trade, and I'll read it off and then we'll look at it in the what if calculator. But here's our official paper trade. We are looking to buy the October 27th 340 strike call. At the same time, sell 2 of that same expiration 350 strike calls, and then come in and buy our protection, which will be the 360 strike call. And I'm going to set that in and send that over to the what if calculator. And you will see something that looks very similar to Options Playbook. Now, this is using real data, using real implied volatilities from where the marketplace is at. And to start with, the butterfly's not that exciting. The green line here is the profit and loss graph to start with. And you got a wide range where your break-even points are at. Underlying market right now is trading at 329.30. That's where this is at. Break even is all the way around this. But what will happen is, as after the earnings announcement, implied volatilities will come in, and this line will start to morph towards the expiration graph that has hard lines, which when that happens, this range will go away, and this becomes a loss if the market doesn't get to 340. And if it blows through it and goes all the way up to 360, that would also be a loss in that position. So we got that 20-point range that we want to settle in, but it would actually be 20 minus what we end up paying for this trade, which I think is $1.24. So we'll put it right at $1.20. Well, let's make it $1.25. One of the wonderful things about a butterfly too is that you're doing 3 legs. And if we're doing them around earnings, there's a lot of interest in this expiration. There's going to be a lot of volume, and you can see that over here. A lot of open interest on a lot of these stocks just because they're mega cap tech stocks, and usually a lot of volume on the option contracts too. So you can get decent fills on 3-legged trades, 2-legged trades. So I would target somewhere at the midpoint if I was putting this trade in. Okay. So what do we want to happen after we put the trade in? We hope in the marketplace will make it up. The expected move is right around 345. We want it to trade somewhere between 340 and 350. That's ideal. If it goes beyond 350, well, yeah, that's gets you a little nervous all the way up to the 360 level. But if we're trading anywhere in this range, we're going to want to get out of this trade. And I know that this is a 10-point wide butterfly, which means that this thing could trade for 10 points, but don't ever expect that with a butterfly. You have this at the money option contract that has a lot of juice in it. It's trading for around $1. And if I'm buying that option, or if I'm selling 2 of those option contracts, I have to buy to close those to shut them down in order to make the most of this trade. So if we do that inside that butterfly, and the marketplace does trade within that range, we want to look to get out sooner than later. If we see that market get anywhere near that 350 level, we want to get out. Now, I want to give you a realistic expectation. One of the downsides of doing the Microsoft this week is that they're announcing on Tuesday, and there's still going to be 3 full days of trading. You've got all day Wednesday, all day Thursday, all day Friday before a lot of that juice and a lot of that time value comes out of our option contracts. So if I put this on for 125 and I see it trading for 250, basically a doubler or $3, that's a good trade. There's nothing wrong with that trade. If I did this trade and I did it more, we always look at things on a 1 contract or 1 unit basis on Options Guy TV. But if I did 5 or 6 of them, and let's say the market did run up to 342 or something like that, and I could sell this for a doubler, well, I might sell half of the position. And that's kind of a field thing for me, depending on how many contracts that I had on. We'll say we had 4, you sell 2 and you let 2 ride a little bit. I don't mind doing that at all on these trades. But if I'm just doing a 1 contract basis and I can double this position, I'm risking 125, because if I'm wrong and the market goes the other way, this is going to be trading for nothing. There's going to be nothing left. If the market trickles up after earnings, well, you still have some chances of the underlying trade working out. But in this scenario, that's all that I'm looking to do. Anywhere from $2.50 to $3, I'm going to try to sell this and get out. The one big thing that does scare you around earnings is that the market could gap more than a one standard deviation movement gap all the way up to the 365, and you'd be right on direction, and you'd be wrong on your forecast. Then you would have wished you would have just bought that call option outright at that $3 level, because that would have paid you out. But this is going to be the trade. This is the paper trade for the week. And I do see Eric in the chat box has a couple of things that he's talking about. It looks like he says, let's put the first one up. Eric says, nice support around 315 in Microsoft. All right. I can try pulling up a chart. Let's see what happens there. Yeah, not too shabby, right around that range, right on the downside. So if you wanted to, you want to be bearish 15 points, which is about 15 points, which is about the expected move to the downside. So if I was looking at puts, I would be targeting right around that 315 level. And let me zoom in a little bit on that. 314, 315, right in here. Looking at the chart. Yeah, not too shabby. So that would be, if you want to get bearish on Microsoft going into these earnings, that wouldn't be a bad area to target. We're looking, once again, we got a fairly high PE ratio on Microsoft. It's trading around 33 times earnings. Apple's a little bit lower than that. I think they trade around 28 times earnings. And then Google comes down in usually right around 20 times earnings on the PE ratio. So it is a little scary to be in this in Microsoft and some of these mega cap techs, because a lot of people are claiming that they are overbought. I don't mind. Like I said, flip a coin. I chose to do this to the upside as opposed to the downside, and not too bad. All right. Also, Eric comments. Let's do the next one. Also selling vertical puts on the month at the 398 support in NVIDIA. Oh, the NVIDIA paper trade. Okay. So we're going to go back and look at NVIDIA, and yeah, not bad. On NVIDIA in general, we have a paper trade going on, which is a deep into money option contract. I have that in the paper trading portfolio. This is the live portfolio that I'm showing right now. But yeah, this is a great range, and I agree with that. I do want to avoid earnings, so that does remind me. I got one last thing that I want to look at in Google, because we did look at Google, and I think I went 1 week extra in Google. I wanted to be done this week in earnings, but on the paper trade, we had the Google. Let me pull up the trade 1 second here. I'm on the other side, so it's going to take me a second. Don't worry about it. And I'll pull up where the Google was at 150, and we sold it for about $1. And it's now trading, because Google has gone down a little bit, like 3 points since we put that trade on. And that was a deep. So here would be my follow up on Google. If I had that position on right now in the paper trading account, if I had that account up, and I would just buy it back. I looked at it earlier today. It's trading for 30 cents. You made about 70 cents. You made 70% of your premium, because it was a $1 trade. My normal, I'm usually happy if I can make 80 to 90%. So that would either mean that with $1, the math is simple, right? We could buy it back at 20 cents or 10 cents. 15 cents is usually about where I would go at. So we've made the bulk of the premium. I would close this out after earnings, go and sell another one. That simple. That's where I would be at. So in the Google paper trade, we'd be closing this position out, let them announce earnings. If we're in the fig leaf or the vertical spreads or whatever Eric kind of mentioned in here, what do we say? Vertical puts on the month. Also selling the vertical puts on the monthly. Are we talking about the puts, or are we talking about the calls? I think that one you're mentioning the calls, because that's going to be on the upside on the video. Paper trades. Oh, no, you're selling the puts to buy the stock down around the 398 level. Okay, that makes sense. It's 425. What chart was I looking at up there? Yeah, so that was 500. That's where we were targeting our call was around 500. You're saying down around 398. All right. Yeah, look at the solid support throughout there on the video all the way through this. Yeah, that's definitely a solid level right down around this. I don't mind selling a put in that range. You're getting a lot of premium for it. And we've came down, we've touched the 410 level, 1, 2, 3, 4. Yeah, right in that range. There's some solid support. Now you'd be scared if you I would look at this trade too on the video and treat this as if we did break through that, that would be a breakdown in the underlying stock. And I'd be nervous about where that's going to stop at after that trade. If we were to ever break in that level, look at that, we go all the way down to 370, and then there's that gap between 370 all the way down to 320. So, yeah, if we did ever break through this, I could see getting, and it's hard to say this, but I wouldn't ever want to get short NVIDIA. Let's put it that way. But I would maybe look at a long put spread. All right. I look at the clock, and that half hour flew by. So, fun week in the marketplace, looking at all the potential earnings in the mega cap stocks. We will do speculation trades, and I always want to emphasize that this isn't the staple in the portfolio, but I can't come out and talk about a fig leaf every single week on Options Guy TV. I think I would bore you to death, right? There's opportunities when we talk about them, but every once in a while, I think when we're talking about the mega cap techs, and there's so many people that have these positions on, it's one chance and one opportunity to learn a lot about option pricing because a lot of stuff happens around these earnings reports and how these options are affected by that specific report. So we're going to look at a lot of these trades, and I do like looking at them and I do like trading them. So why not? So this is the 1 week. This is the heart of earnings season, if you will. And we're going to focus on that this week. We'll come back next week and we'll add another deep in the money call option on our position to try to start getting long the market going into November. And it's scary with what's going on geopolitically, but we're going to do it in our paper trading account. And that's it for this episode of Options Guy TV. Please click subscribe, ring that bell, pound that thumbs up if you're on the YouTube station. And we'll see you this Wednesday at 11 a.m. for the next edition of Options Guy TV. Thanks for coming, everyone.